Today on the final bar, we'll do our normal Monday routine. We'll hit the market from three directions: top-down macro, sector rotation, bottom-up stock picking. Today, the S&P not up dramatically, but certain parts of the S&P really pushing to the upside, with energy stocks up over 7%. The XLE really accelerating to the upside. So most of the big gainers were the energy space, things like Occidental, Marathon Oil, Apache, and others rising big time. Let's look at all those charts together. Ladies and gentlemen, this is the final bar. Hey everyone, happy Monday. Welcome to the Final Bar. I'm your host, Dave Keller. I'm the Chief Market Strategist here at StockCharts.com in a rainy Redmond, Washington. Thanks for joining us every weekday after the close as we look at these markets together, focus on the message inherent in price action, inherent in the charts, understand how the charts can inform us about investor psychology, investor behavior, and what investors are doing with their feet, voting with their capital. Certainly an impressive day for many parts of the market today, with energy stocks up significantly, followed by financials and industrials having a pretty good day. So as I do my normal bottom-up process, which completes my weekly routine going, on Sunday into Monday, I'm struck how in certain sectors, there are just a lot of really solid charts. So when I think about the big picture and I think about the S&P bumping up against resistance, I think about sentiment at extremes and the concern there. I'm then balancing that with the fact that on a bottom-up, perspective, there's just a lot of charts that look really good. So I think we're in that situation where, the market overall, you could argue, has been overheated with an extreme rise, but there's plenty of upside in certain spaces. So it's more of a stock picking environment than maybe we would have thought before. We have some great guests coming up in the show. I was really excited. And just in the last couple of weeks, we've had some fantastic conversations and really enjoyed bringing some guest perspectives into the conversation. Tomorrow, we have T.G. Watkins from Simpler Trading. He's done a great job on one of our other shows called Your Daily Five, and excited to have him on the show tomorrow, talking a little bit about the Simpler Trading indicators called the TTM Squeeze that we have as part of our ACM platform, or ACP platform, excuse me. We're going to take Wednesday, Thursday, Friday off this week for the holiday. Hope everyone's able to celebrate and do so safely with those that are important to you. We'll be back with you on Monday. And then on Tuesday, December 1st, Sean McLaughlin from Trade Ideas and All Star Charts is going to be joining us on the show. Let's get to our market recap. And again, if you missed the show on Friday, I encourage you to go back. There are weekly wrap shows where we go through the Mindful Investor Live chart list. We spent a lot of time just talking about the overall perspective. And, the big picture is price bullish. And you think of my three steps: price, breadth, and sentiment. Price, thumbs up bullish; breadth, thumbs up bullish; sentiment, thumbs down bearish. And I mean contrarian bearish, meaning the readings are so overly bullish, euphoric, that just like John Templeton's quote on, bull markets die in euphoria, it sort of feels like we're in that situation. Now, it's not a timing tool necessarily. It doesn't tell you that the top happens at that moment you get those extreme readings, but it tells you that stocks have moved so high and people are so optimistic about it. The problem is there's no one left to push prices higher. I wrote an article just last week, and I'll show you very quickly. It's part of our Chart Watchers newsletter. If you go to the articles page, this one here that says bull markets die on euphoria, you'll see some of the charts that I'm referring to when I mention that the market has felt a little bit overheated recently. But when we look at the overall, my question is, who's left to push the market higher? Someone, because S&P is moving higher today, up over 0.5%. Still not able to get above that key 3,600 level, but moving in that direction. Really moved up out of the open, sold off to flat midday, and then rallied into the close. So up about 0.5% overall, 35.77 and change. The mid-cap index up even more. Small caps were the big gainer today, up over 2%. So this continuing this pattern of small over large, of cyclicals over defensives. This has been a pattern we've seen evolving in the last couple of weeks plus, and we're continuing to see that certainly today. The NASDAQ 100 flat for the day, which tells you about the lack of leadership from the FANG stocks. Some of the least attractive, I used to say everything looks good except for energy, financials, some other things. Now what I'm saying is the average chart looks really good to pretty good, except for things like the FANG stocks, which are kind of at the lower end of the range and not really participating. What a change, what a sea change from what we'd seen not too long ago. Looking at other markets, bond prices down about 0.5% in the form of the TLT 10-year yields up to almost 86 basis points. Looking at commodities, oil up pretty good, and energy certainly the story when you look at the equity space. Gold and silver down, actually sort of traded pretty heavily lower out of the open and continued to have pretty muted returns during the course of the day. Let's look at a daily chart of the S&P. We'll continue on with some of the other themes here. So, here's our big picture look. And again, we've talked about this range from 3,600, the green shaded area, down to 3,200 to 3,250 or so. That's the blue shaded area here. I think they're very justified through today in terms of significant resistance that's been tested and has repelled advances, significant support that has repelled declines and has provided some stability when the market is pulled back overall. It certainly seems like that trend is still in motion. I've seen some people, the way that I'm highlighting is seeing the September peak as the starting point, the October peak as a retest that was not able to eclipse it. What I've seen some people do is draw this more like a kind of like a pennant pattern or a symmetrical triangle, kind of doing this and looking at the lower lows and the lower highs. The lower highs and the higher lows is consolidation, this coil pattern of sorts. And if you do that, you could argue we've now broken out and all of that, which is totally fine. But I think it gets you to the same point, which is until you get above that starting point, that peak from that first top, it's not a valid breakout yet, right? I mean, it's still sort of broken out, but stalled. And I think that's where we're at in either scenario. So until we get above 3,600, which we've not really been able to do with that follow through, I think at this point we're still sideways. Now, seasonally, you're looking at the Thanksgiving week, holiday week tends to be shorter trading, lighter volume, more positive and negative. It's pretty rare that you have the market going down significantly on a week like this. So all else being equal, wouldn't be surprised to see a little bit further upside through the course of the week, but we'll have to see what happens. So that's the big picture, still at the upper end of that range. Again, I think when we get to our shifting stock segment, you'll see what I mean about just some attractive patterns out there. We've been highlighting them randomly. It's just, there are a lot of them. And as I'm looking at the entire S&P 500 chart by chart, you're just struck how in certain sectors, and the ones we're going to focus on are communication services, consumer discretionary, financials. We'll look at some energy. These are sectors where the average chart just looks pretty good. And the good news is, or I guess the balance of that is, there are charts that don't look as good. And so in any of those four sectors, there are names that are not working as well. But the key is that there are stocks that are working. So I think if you're screening effectively, if you're following the charts, I think there are opportunities for you to do just fine through a period like this, where the S&P overall hasn't been moving a ton. As I mentioned, energy, the big story, up over 7%. We'll try to get some of those stocks in a little bit. Financials, industrials after that. On the downside, only a couple sectors down for the day: real estate, healthcare, technology. It's so funny. If you asked me a year ago how likely it was that we would see predominantly energy stocks in the top 10 scooter gainers, I would say you're crazy. And even a month ago, I would have said, no, I don't see it. And look at how quickly that has reversed. Occidental up significantly, almost 17% today, really rallying to the upside. So obviously some significant movers in there that are pretty impressive. I did want to point, we're going to wrap here in a second to go to the sector setups. As we're getting to some of these, as we think about some of the stocks, I did want to highlight a couple different features randomly when I can. And I would point out that on our ACP platform, we actually just added scan results. So I have a scan that looks for new 13-week highs in the S&P 500. You basically can go and click on that tab. You can bring in any of your existing scans or our predefined scans. I brought that up, and that's where I quickly saw all the energy stocks on the top there. You can click on the first one, hit the down arrow to just quickly flip through each of those charts. It's a really impressive way. Once you get a screen that you like to follow, to look for ideas, just to manage the overall movements in the S&P and the markets, it's a really powerful way to do it. That's just a new feature that was added in the last week, and I wanted to make sure that you were aware of it. Let's get to our next segment called sector setup. So our second prong, now we talked about the big picture. And again, I didn't get too much into the sentiment story, only because I feel like I beat that pretty hard on Thursday. We had Mark Young from Wall Street Sentiment on the show. We talked about it there. We talked about it again on Friday. So if you missed those, I'd go back to those episodes and you'll hear the argument for the extreme sentiment and the euphoric conditions I feel that we're under. But if you look at the trends have been positive. Let's look at the sector movements and see how that relates to this big picture overall structural bullish market. Here on the weekly, which we're going to start with the weekly RRG, and as I always mention, if you're not familiar with this, look up my friend Julius de Kempener. He hosts Sector Spotlight, which is a show on StockCharts TV. Does a really good job explaining this methodology which he created. But essentially, you're looking at the 11 S&P sectors and how they're rotating around the S&P 500, which is kind of at the 0 point, the crosshairs in the middle. Energy's down here in the lower left, and for months and months, if not years, when I would bring this up, energy would be down and to the left, and I tell you, and ignore energy, because usually one of the last things I said, and energy is not to be paid attention to until it improves. We're there. I mean, we're at the point in the last couple of weeks where the rotation has certainly turned positive. The fact that it's so far to the left tells you that the long-term relative strength is still favoring other places, and that's about right. It's still sort of early on in this transition, but you cannot deny the improvement that you've seen in the energy sector, and that's why this is able to pivot so quickly and now for 3 straight weeks head in a northeasterly direction. Still a long way to go in this rotation until it eclipses some of these other sectors, but certainly, in terms of the most improved award, energy is certainly there. Worth noting, consumer discretionary and technology, especially rotating southwest. That's the direction of deterioration. The strongest sector, industrials, furthest to the right, followed by utilities, which is been improving and is the only other of the 11 sectors in the leading quadrant. Let's look a little shorter term. We'll bring up the daily RRG, and I like to look at both. The weekly gives you the longer term view. The daily gives you the shorter term view. Here's where you can see the strength in energy. So coming out of a pretty beaten down, basis on a relative basis, but you can see how the XLE has really improved. And again, the rock star on the daily RRG, speaking to the strength on stocks like Occidental, and it's all over the place. It's Marathon Oil, it's the Integrateds, it's the E&P stocks. It's all of them that have really improved on stronger, caught up with stronger oil prices, to be honest with you. Second and third, financials and industrials. So again, when I'm looking at some of the better charts, we've been talking about industrials and materials. We're going to focus a little bit more on things like financials and energy, some of the other sectors today, but certainly seeing broad improvements across there. The worst has been utilities, and it's the weakest of the 11 sectors, again, on the short-term basis, because it had been a strong relative performer. The long-term trend's still okay, but on a short-term basis, you've essentially seen this rotation into energy and financials, industrials, away from things like utilities, real estate, and others that have struggled a little bit. Also worth noting, healthcare, which is rotated down here. Technology was actually on the in the lagging quadrant and did a bit of a round trip here to the left side of the 0 line, which is not a good signal. That's really speaking to the relative weakness overall in technology. Now, again, that's dominated by some of the mega cap stocks that overall are still okay, but they're okay when other stocks look really good. And if you compare the average semiconductor stock to the average FANG stock, it's certainly been favoring semiconductors. And that's why the XLK weighted into some of those mega cap hardware and software names are rotating down to the lower left side. Let's look at the candle glance page. This is the second thing I like to do, to look at the 11 S&P sectors. We have the S&P at the bottom. This is where we look at what's working, right? What's above moving averages, what's below moving averages, what's testing key levels, what's changing. And the move in energy certainly jumps off the page. And again, it might be a little small to see as we jump in here. We've talked about the XLE chart. We've talked about this, this movement from the low in March to the peak in June, how we pulled back to the 38.2%. The 50%, and then we broke down through the 61.8%. Felt like this was going to go and retest the lows, but this gap certainly changed things. And a gap on its own causes me to be, skeptical and just look for some confirmation. We've had that. And now on successive Mondays, you've seen this continued gap higher, this push higher. This was today's bar with the XLE up 7%. This pushes us above the 38.2% level and back to the August swing highs, which I don't have a dotted line right there, but that's certainly what I'd look for. But now you have a rotation above trendline resistance, above the 200-day with upside follow through, above the final Fibonacci level, which again, if you ask me to anticipate where it would head, I'd say we go back to 46 and we retest the June highs. That's where things have set up. We've broken through the last resistance. I think it's overall in pretty good shape. And on pullbacks, you look for some of these Fibonacci levels. So now that we're above that sort of 36, 36.50 level, that's where I would look on any sort of pullback. That's where you'd hopefully bump up a stop if you're in there, and then look at the relative strength and how much it's improved as this the character has completely changed on this chart. So energy certainly up a lot. If you missed a day like today, it can feel like you've missed out on a lot. But again, big long-term moves, a lot of times will start with bigger short-term moves, and that's okay. The idea of trend following is to understand them and follow them. And the trend in energy certainly seems more higher than lower. The next place to look would be financials. When you look at the XLF, similar kind of thing, it had resistance at the 61.8% level, broke above that, and now it stayed above that. We talked about 2650 being a good support level. We've tested that and now followed through above there, made a new closing high for this little rotation. This line that you're seeing is not a really important one. It's really keying in on these highs last year before the big break to the January, February high. So I thought it was interesting just to look at the symmetry there, but overall, the trend is positive. I think you continue to watch something like 2650 on any sort of pullback, even 27 as a shorter term line in the sand. The good news about these charts making these stepwise motions, you can continue to bump up a stop and you have a really clear line in the sand at which to revisit a long position or revisit a bullish perspective. But same thing, you can see the acceleration and the relative strength making a new, we'll call it a 4 or 5 month relative high, which is a pretty impressive run to the upside there. Just one last thing I wanted to talk about. We talked about energy. We talked about financials. I did want to talk about consumer discretionary. It feels like other sectors have, started to impress, and things like the late cyclicals have really emerged in a position of strength, but don't count consumer discretionary out. If you take Amazon out of here, Amazon's obviously a pretty big weight in the XLY, and Amazon not being, a breakout at the moment, is certainly holding this back a little bit. If you take the weighting out of there, you'll see it's breaking to new highs. The relative strength is going to look even more impressive. When I'm doing my bottom up work, I'm finding a lot of really compelling charts in consumer discretionary. And we come back from the break, I'll highlight some of them. Things like automakers. It's the big the big box stores. It's all over the place, really. And it's even travel names, things like Royal Caribbean. These are names that are actually breaking out to the upside, setting up with these really impressive long-term bases. So don't count out consumer discretionary just yet. If you've been caught up in the financials and the energy and elsewhere, we're going to look at each of those and highlight some of the key charts here in a minute. Let's take a break. We'll be back with shifting stocks. We'll see you in a minute. Hello, everyone. Welcome back to the Final Bar. This is Dave Keller here at StockCharts.com. Really appreciate you watching our show and very much appreciate hearing from you. Feedback on our shows, our hosts, our content, but especially questions that are coming up as you are analyzing your own charts. Shoot us any questions that you have. The Final Bar at StockCharts.com is our email. On Twitter at FinalBarSCTV. Or on our YouTube channel, just put a comment below the video you're watching. We're going to have another mailbag segment. On Tuesday's show, we have a shortened week just today and Monday and Tuesday of this week, but we'd love to answer one of your questions going into the holiday, help point you in the right direction. Our next segment is called Shifting Stocks. This completes our three-pronged approach to analyzing the equity markets. We talked about the top-down perspective, dug into some of the sector themes, and really focusing on the explosion to the upside in energy and financials. What I want to do now is go into, sort of what comes out of my weekly process of analyzing a bunch of charts in the S&P 500. And it's something I've done for a number of years. And I will tell you, especially in an environment like now, because of the weight in the FANG stocks, a lot of times you will feel like there have been times during this upswing where it felt like everything was good because the S&P was going higher, even though it was relatively narrow. So you had a lot of stocks that didn't look as good. And by doing the bottom-up analysis, you could see it was really a relatively narrow group of stocks that were leading. Now you have the opposite. You have some of those mega cap names struggling a little bit, but overall the market's holding up there because other things have emerged and are really rotating into a position of strength. What we're going to do is just hit on as many of these as we can. I've got about 30 some tickers written down, and I'll start from here. Start with communications services. Charter Communications, CHTR, is the first stock I look at because I do it by sector and by group. And so the entertainment names within comm services are the first ones I looked at. And this has been a really fascinating chart. Hit a peak in early October, which is a little later than the overall market, which peaked in September. made a new swing low, came right back and had this ridiculous bearish engulfing pattern here a couple weeks ago. Now right back up. And you can see the 660 level has been a clear ceiling. Every time it's hit that level, we've had a shallower pullback. And now my question is, are we able to eclipse it? I think a stock like this that breaks 660 is setting up for, obviously a much higher move, or a much stronger potential for upside if you can get a confirmed break. Have not had it yet though, and that's what I would be looking for there. Now within communication services, you have some pretty interesting setups. Comcast comes to mind. This internet entertainment group. Nice breakout above the September high. So you have that sort of support around 47 if you pull back a little bit, but nice rally and holding up there pretty well. In that same bucket, I put something like Disney, again, breaking out. This almost looks like a bank where you've had the break above, and now you can see a sort of a pullback to 135 as still being within a nice uptrend. Up pretty good today, about 3.5%. Let's see, Discovery, DISCA has had a nice breakout as well. So a lot of these names that I'd sort of been counting out, you've sort of not been paying attention to. The relative strength was stagnant, sort of flat to down. But see how it's coming off the lows and now exploding to new swing highs. So stocks making the new swing high, pretty impressive, just getting above its June high now. And so, a nice trend. I think a trend line from these lows would be what I would be looking for, just to make sure that trend continues in that similar sort of fashion. Other stocks in this group would be Fox, which is probably the least attractive out of the others because it's not really breaking out just yet, while others have already gotten above some of these swing highs. And maybe Viacom would be one other to show, with a nice rotation off the 50-day moving average, breaking above the September high. So again, these are in short-term uptrends, some of them becoming overbought. So I think you watch for trend line breaks to see if they're still holding up there okay. You compare what I just showed you to some of the video game names like Activision, like EA, and you can see why I'm probably less excited about some of these. While things like Viacom breaking out, Disney swinging higher, Comcast breaking to a new swing high, these are actually making a pattern of lower highs and lower lows, broken down through the 50-day moving average, now below the 50-day and remaining there, testing the 200-day moving average, which, most stocks are sort of above their 200-day at this point. So, certainly feeling weaker on a relative basis. You'd love to see that rotate higher, but until you get a higher low and breaking above a swing high, I think you hold off on something like this until you see some improvement. The other problem for communication services, I mentioned, it's the FANG stock. So this is Facebook, which again, it's not horrible. It's just not very good. And on a relative basis, you can see why it's making a new swing low on a relative basis, because it's just not breaking out while other things are. Netflix is another one, sort of this triple top pattern, now once again at the lower end of the range. So if you buy into this is a range and I want to buy weakness, I get the argument, but I'm seeing a stock that's not doing well while others are doing well. I'd much rather buy stocks where the relative strength line is breaking out to the upside, not breaking up to the downside. That's comm services in a nutshell. In consumer discretionary, one of the top ranked stocks in our entire universe, large cap universe, is Gap, which was up almost 7% today, another Gap higher. And the relative strength really tells the story. Really, since early April, this has been a consistent outperformer, sort of higher highs, higher lows, a nice uptrend, hasn't even touched the 50-day. The relative strength line goes up. Those are the types of charts that I would assume will continue in that direction until proven otherwise. And I think the trend overall has been pretty solid. Tesla, when you look at the automobile stocks, Tesla's obviously the first to look at, making a new 52-week closing high today, which is certainly an impressive run. The relative strength has been good. Tesla had been down and out, sort of stagnant for a while, sideways. I think this completes a breakout to the upside. I wouldn't be surprised to see further upside there. What's interesting there is the other automakers actually look pretty good. There's been stretches where it's been Tesla and then the forgotten automakers not looking as good, but GM's chart looks solid. Ford's chart looks really good, right? These are price breakouts, relative strength trends are okay, not overextended at this point. So kind of holding up there pretty good. Other things that look good, and this is, again, when I'm at this point in the bottom-up review of stocks I'm thinking about, I can't imagine the S&P is not completely blowing out to the upside. The reason is because other sectors not doing as good. But Target, incredible price breakout, new 12-month relative high, new price relative high, which is pretty impressive. Best Buy as well. So, maybe not as extended, holding up pretty well over an ascending 50-day moving average. I think those are setting up really well to accelerate to the upside going into to year end. If you're more of a bottom fisher and looking for things that are coming off of weakness, Hanes Brands might be one within consumer discretionary, coming out of an oversold condition, bouncing off of the 200-day moving average. I think as long as it holds the 200-day, you're in pretty good shape. If it would break that, I'd be concerned about potential for further downside, but potentially refilling that gap and going more to the upside. Mohawk is another one, and this is one of those that looks more like a bank. A June peak has broken out, now retested it. These are easy charts to follow because there's a really clear line in the sand here around 115, 116. As long as we hold above that, I think that primary trend is still positive. If you told me charts like Royal Caribbean would be testing the upper end and testing a 6-month breakout level, something like Live Nation, which is literally built on people going to concerts, I would not think in a pandemic that seems to be getting worse that this would be breaking out, but it is. And again, that you have to remember with charts, it's not about what should be happening, it's what is happening. And I can't deny the fact that LYV had resistance in June, it met it in September, it now gapped above it and retested it. That's a really clear downside support around 60 to 62. It holds above that, and the primary trend is in pretty good shape. So some of these charts that even shouldn't, I think, potentially be going higher, they certainly are. And it speaks to expectations of market resiliency, of the economy opening up, of vaccines taking hold, and us, spending on things like cruises and concerts. But it certainly feels like a long time off right now. And so I think that's the concern is, do these stocks work? I think the charts tell you, don't worry about any of that. Just follow the trends. As long as the trend goes higher, you want to stick with it. We don't have enough time to get to some of the financials, but I will tell you, whether you're looking at regional banks, which is the KRE, you're looking at insurance companies, KIE, you're looking at banks, KBE. These are all charts that are going up, similar to the chart of the charts we looked at recently. They've tested the June high, they've broken out. So I think overall they're all setting up pretty nicely, and some individual stocks within financials certainly doing their part to follow through to the upside. So some resilient charts in a number of sectors. We need to wrap the show though and go to the 3 and 3 charts. 3 minutes. Here we go. Chart number 1 is the XLY. We're going to have a sector theme here. As I mentioned, when I do my bottom-up stock picking routine, go through the S&P 500, I was struck this week about how many just positive charts there are. And even though we debate about the S&P, whether or not it's going up or whether or not it's not, the fact remains that there are sectors and there are stocks that are doing just fine, and you want to be in those charts that are doing well. I think within consumer discretionary, if you take the weight of Amazon and Home Depot, which those two are probably 35 to 40% of the XLY, if you take those two out, I think the price would be a lot higher, because there are charts we've talked about, things like the entertainment stocks, the media stocks, and others that are doing well. It's counterbalanced by things like video games and the FANG names within communication services and elsewhere that are not doing well. Within consumer discretionary in particular, I'm looking at automakers, I'm looking at retailers like Gap, the big box stores. Those trends are all fairly positive, and that's why that sector is doing just fine. Chart number 2 is financials, the XLF. We talked about that breakout, and I think a lot of the stocks within the group, things like insurance companies, banks, regional banks, look very similar to the XLF, where you had a peak in June around about there. You broke out. You have a clear line in the sand for support on any pullback. You're starting to get some shorter term swings. So I think if you're in some of those names, you can bump up those stops as the price continues higher and overall lock in further upside. But the trend overall seems to be setting up very well. And I think on charts like Morgan Stanley and regional banks like COF comes to mind, just setting up really nicely for potential further upside. The energy sector, the third chart, the XLE, is certainly the story of the day here, and it's been the story of the month. November has been marked with a complete rotation from one of the weakest sector, not one of them, but by far the weakest sector, lower highs and lower lows, to being a sector breaking above its 200-day, breaking above trendline support, breaking above the final Fibonacci support level. At this point, my sort of mental stop is 36 to 36.50. It stays above that Fibonacci level. I think we have a chance to continue higher, push on to 46 and retest those June highs. I often get asked on a chart like this, but did I miss it already? You could ask me that 2 Mondays ago when it gapped higher, and the answer would have been, well, not necessarily. And then last Monday, did I miss it? I don't think so, right? These trends can continue much further. So don't think just because it's gapped or because it's up a lot today that it can't continue to be in position of strength. Watch your stops, watch your downside risk, and you can lock in those gains. Folks, that is our show for today. Thank you so much for joining us every weekday for the final bar as we recap the charts that you should be paying attention to. If you have any questions, please get them to us via email, thefinalbar@stockcharts.com. Hope to answer them on our show tomorrow. For StockCharts.com in Redmond, Washington, I'm Dave Keller. Be safe. Have a good night.
Hey, Grayson Rose here with StockCharts. Thank you so much for watching. I hope you enjoyed that video. If you did, consider giving it a like down below, maybe leave us a comment, and if you're new to the channel, you can subscribe at the link up above. We're gonna bring you daily content from an incredible collection of technical analysts and financial experts.